short term, it's all about volatility. It's all about distortions. It's all about recession risk. It's all about the sort of flipping of the pendulum between recession and no landing scenarios. But when you look beyond that, I think we will see that something subtly different has actually emerged from all of this. And ultimately, it's that super cycle, and it's about the balance of power between labor and capital. And so, for capital, it's going to be harder to eke out returns, and you're going to have to work harder. For labor, for the real economy, for wages, for inequality, I think we're looking at something stronger. And I think you'd have to have sort of quite a myopic view to think that's sort of net bad for the world. I think in terms of these very long sort of 50-year super cycles, and those super cycles, which really drive the sort of macro environment, they're set by the balance of power in the economy, particularly the balance of power between labor and capital. So you have to think about the capitalist system as this sort of inherently unstable mechanism. And so we design these institutions and rules to try and manage that instability. And the sorts of institutions that we come up with depend on who's in charge, basically. So if you have a situation where labor is dominant, you tend to focus on full employment and high wages and narrow inequality. When you have a system where capital is dominant, the focus is very much on low inflation, low interest rates, high asset values. And so we've had big shifts in this over time. So there's basically been three of these super cycles. So you have one super cycle that runs from sort of 1870, which is the sort of start of the capitalist system, runs up until the First World War, completely dominated by capital. So you have massive technological change, massive globalization, workers get absolutely killed, labor is completely annihilated, and capital is dominant. And then you get to the sort of end of the 1800s, and that begins to break down. You start to get a political reaction to that. So you get the sort of beginning of populism, beginning of anti-globalization, beginning of protectionism. Then you have the two world wars, and then you emerge from the Second World War with labor completely dominant now. So we've completely changed. And then we have sort of 30 years, 40 years where labor is dominant, and you end up with stagflation in the 70s. And so everything that's happened since the 1970s has been this reaction to that stagflation of the 1970s. And that's been a world in which capital has been completely dominant once again. And part of it is demographics. So the baby boomers basically had a midlife crisis and suddenly sort of turned to neoliberalism. And then we had this sort of attack on labor power. So we destroyed the trade unions, we set up independent central banks, we globalized, we opened up product markets, we financialized. And so everything that's happened since sort of 1980, so you had sort of Thatcherism in the UK, Reaganomics in the US, has just been this continuous breakdown of labor power. And then for a while, we sort of concealed this because this was leading to massive inequality. So wages became very stagnant. We had massive increases in inequality. We concealed this for a while with this big subprime debt bubble. And then that debt bubble burst in 2008. And so we were stuck with this sort of malignant economy, this sort of lukewarm economy. We had this terrible policy mix because the last sort of throes of neoliberalism was austerity, and central banks couldn't offset that austerity. So we were stuck in this sort of nasty situation that was quite similar to the one that we were in the sort of end of the 1800s, because we'd gone back to a world where capital was completely dominant. It was globalization, it was technology, it was massive increases in the profit share, massive decline in the wage share. And then before COVID, this system was beginning to break down. So we had Trump in the US, we had sort of Brexit in the UK, we had anti-European skepticism. So you could see it was beginning to change. We had sort of a move towards MMT and fiscal dominance and all of that stuff. And then COVID, followed by the war in Ukraine, have just completely supercharged that. So I think, when we look back on the last 2 years, when we look back at COVID and Ukraine, we're going to see these as these sort of big historical events. And each of those turning points in that very long super cycle is sort of coincided with these big historic events. And I think that's what we're seeing again.
And that period, the one we're sort of leaving, it was epitomized by probably sort of 2 or 3 trades. It was generally an equity bull market, obviously we had these significant moments and pullbacks, but ultimately it tended to be an ever narrowing equity bull market. And obviously for a long time, it was a bond bull market, but that was the comfort blanket for most investors. Was there any other elements of that regime that investors sort of held on to? Because presumably we're going to be talking about that regime also coming to an end, that investment regime.
Yeah, so it was, it was fundamentally, it was driven by a sort of secular disinflation trend. So we had interest rates coming lower and lower. We had this very long-term sort of secular bull market in bonds. And that really drove the way that other markets were performing too. So, the big thing was obviously the sort of 60-40 portfolio because, we're in a world where it was sort of continuously driven by demand shocks rather than supply shocks, with this very sort of benign regime where there were no big nasty supply shocks. And so, in that sort of world, bonds became this sort of perfect hedge for equities. So bonds were continuously sort of re-rated, equities were continuously re-rated, and you had this beautiful correlation between bonds and equities, which just meant that you could create these sort of wonderful portfolios just with those two things. And then by the end of the sort of 2010s, this had driven, this sort of big run in particular types of stocks. So you look at the 2010s, you get this sort of massive outperformance of growth versus value, the big US tech, the FANGs. And that's, historically, that's incredibly unusual. You can get data on this back to the 1920s. That sort of continuous outperformance of long duration, tech and growth, it only ever happened in that decade. There's no other period where that's happened. And I think that was the nature of where we are. We had this horrible policy mix. We had the austerity. We had central banks sort of trying to offset that, and they couldn't. So you had perma-zero interest rates. You had sort of continuous QE. And this just drove people into duration. So, a very unusual sort of bizarro stock market that went with the sort of final, when you look back and you look at sort of negative interest rates, I mean, that was a clue that something had gone sort of, profoundly wrong with the macro regime. It sort of told you that your policy mix globally was just completely bonkers. And so, we had negative interest rates, and then we had a stock market that really reflected that sort of world in bonds. And I think that's gone. I think that's what's starting to break down. All of those trends are beginning to reverse.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.